I've been trading for over 8 years, and these are my top 5 trading tools which revolutionized my results. Trading can often feel like a puzzle, but the pieces just don't seem to fit. Today I'm going to introduce you to some tools which I believe make that puzzle seem a little bit clearer. These aren't your average indicators. These are real world data which helps you understand the market you're trading, but also give you an edge. Every month we throw a special free event, so make sure you hit the top link in the description and come and join us. And as always, leave a comment on your favorite tool at the end of the video. Let's get into it. Some of these tools are going to seem quite advanced, but don't be fooled by the fancy words. I'm going to break them down and I'm going to show you how to use them, and trust me, it'll put you ahead of most of the retail traders out there if you understand these 5 trading tools. Stick with me to the end, you'll benefit from it. Let's start with a relatively easy one. You're in a trade and out of nowhere, your asset moves like crazy. It's probably happened to you before. You've got no idea what's going on, but it is flinging all over the chart and your P&L is running rampant. It wasn't until 10 minutes later that you see a big headline that some GDP data has been released, and you find out it was actually forecasted the whole time. A lot of people have been there. It's a fairly rookie error, but today I'm going to show you how to solve it. You need to find an economic aggregator. Platforms like Trading Economics gives you real-time access to economic releases such as GDP, inflation, or unemployment rates. This is all free on tradingeconomics.com. If you head up the top here, you can go on the calendar and you can see what is forecasted this week. You can change your countries, your category, your time zone, and even the expected impact on these results. Let's say you're trading the Great British Pound US dollar pair. You see, Great Britain have the S&P Global Manufacturing PMI Index coming out at 5:30 p.m. my time on Friday the 24th. You now understand that there is expected volatility at that time on this pair, but it goes one further. You can see that it's actually forecasted to have minor growth, but anything under 50 is still considered negative. So you know that we're still expecting a negative impact on the pound on this upcoming Friday. And things aren't priced in as they happen. Things are priced in way before because we play bets on the market. So you can expect that we are going to see some weakness ahead of this event all week moving into Friday. All of that information from a quick scan on this website. They go one step even further. They give you a consensus figure, which is given from hedge fund managers external from Trading Economics, and they give you a forecast figure, which is their internal analyst team forecasting what they think the data will be. You can really dive deep into economies with this data. So how do you use this? Well, when you log into your trading week, head over to the calendar and dive in. Choose when you are trading and have a look at when it's coming out. The expected impact, this is usually the amount of volatility that's caused by the event. The pairs that you're trading or the nation, you can quick select through Africa, America, Asia, Europe, or you can have a look just purely at the majors, or you can have a look at all, hit save, and before you know it, you're going to have your economic calendar. Write down the key events on the pairs that you're trading and get an understanding of what the forecast is, because it'll give you so much more information on where things can move and when than you will ever get looking at a price chart. Platforms like Trading Economics give you an edge because they break down macroeconomic events in a really digestible manner and give you all the data you need right in front of you, so you're never caught off guard. Okay, let's talk about tips. Now, most people and most households now understand inflation and interest rates. They get what inflation is and what it does. Well, tips is actually a way to predict and forecast where inflation may go. You see, the thing with inflation is it's a lagging indicator. If it's in the headlines, you're too late. Now, tips, bear with me, are Treasury inflation protected securities. Now, these things are your inflation best friend. See, they're bonds, and these bonds are designed to rise in price when inflation climbs. And their yields offer insights into the future inflation expectations. So let's look at an example. We're looking for the spread between the 10-year tips and the 10-year Treasury bond yields. As you can see here, the blue line are the Treasury bond yields and the red line are the 10-year tips. And there's an evident gap between the two. Well, if we actually just measure that gap, we can see that the average is 2.38, which is 2.38%, which means over the next 10 years, the market is pricing in that we are going to average 2.3% in inflation. Now, the signals that you want to look for are when this starts widening. When this starts widening, it's a signal that the market is expecting inflation to rise. And this information can help you predict how inflation will affect the broader market. Whatever you're trading, whether it's FX, whether it's the interest rates directly, or commodity prices. If you can predict inflation rising, you've got a good chance of getting ahead of the Fed. Okay, I'm going to show you really quick how to visualize this. Obviously, we've got the US 10-year yield at the top, the TIPS 10-year on the bottom. If you hit this little plus arrow up here on the top left, the compare symbol, I want you to write in the US 10-year yield and then hit the minus sign and then throw in the DFII10 as well and click enter. It'll input a new chart onto your screen, as you can see here on the purple line. Now, if it all adds it to the same scale, it'll automatically turn this into a percentage, which we don't want. If you see two price scales on the right, it's an easy fix. Just right click the new chart, go to pin to scale, and there'll be an option to pin to existing right scale and click that. And then we're going to right click the scale here and just go back to regular, and it's going to throw the chart back in. Make this color really pop out. I'm going to make it a little bit thicker, so it's the thickest one here. That purple line in the middle is the difference, the spread, okay? It's going to move with the charts as the charts go, but one thing it's going to really visualize for you is the gap between the top line and the bottom line. So it's a real easy way to visualize the spread, and that spread is what we care about. Remember, if that spread is widening, it means our inflation expectations grow, which means we want to start looking at trades in gold and currency sensitive to inflation, the currencies which are sensitive to inflation moves. If we do see this starting to drop, then we can expect obviously Fed funds rate to ease, and we can really start positioning ourselves in the best spot ahead of inflation data. Understanding how inflation is priced in the market can help you stay ahead of the curve and understand what the Fed's thinking ahead of interest rate rises or declines. Staying on the topic of interest rates, let's have a look at interest rate futures. Now, I've shown you how inflation futures work and how you can really get an idea of where inflation adjustment bets are being placed. Now I'm going to show you directly on the interest rate, which those tips will influence, but it's only a minor piece of the puzzle. I'm going to show you how to pick what everyone else is predicting and where they're putting their money based on interest rates for a long time into the future. Allow me to introduce to you the CME Fed Watch tool. What this tool allows us to do is to have a look at how futures markets are pricing expectations, and they're even generous enough to give you a percentile. So right now we're looking at the 29th of January meeting. Let's forecast to the 19th of March 2025. Here we can see the likely percentage based on market expectations of where the Fed funds rate will be. See, the current target rate is 425 to 450. And this right here shows us where we may be. The probabilities are up here. The chance of us easing interest rates ahead of the 19th of March are at 28.4%, with most of the market pricing in no change at 71.6%, and a hike with a 0% chance. People do not think a hike is coming. As you can see, 4.425 or 4.25% to 4.5% is where we're currently sitting, and 71% of people based on these futures contracts assume that that is also where we'll be sitting come March. 28% are being a little ambitious, going for the rate cut, and then a mere 0.1% are going for a 50 basis point cut into March. And you can see these probabilities priced here and those change in probabilities over the recent period. You can see 1 month ago this was a 50% chance that we would be at our current rate, with a 45% chance that we would see a 25 basis point cut. However, now today, there's a 72% chance that we won't see a cut, that will remain where we are, but a 27% chance that we will see a 25 basis point cut. This is a great way to forecast what the Fed are doing, what the Fed and analysts think the Fed is going to do, but also to make sure, especially if you are a currency trader, you can ensure you're on the right hand side of those central banks. This next one is my favorite. It's seasonal analysis. Now, as we know, charts move in patterns, assets move in patterns, and these patterns repeat themselves over and over and over again for hopefully a percentage, and that's what we trade. Well, it happens on a grand scale as well. I'm going to introduce you to something called seasonality, which really came into the eye around commodity trading, because as you know, when farming, you have harvesting season, you have growing season, you have planting season. Well, when most people are buying at harvesting season, that means there's a massive increase of demand, but also an increase of supply. And then through the rain period, through growing season, there is no supply. So the demand gets higher and the prices get higher. This is the basic economics of seasonality, and it can apply to any asset you trade. And today, I'm going to show you how to identify it. For this example, we're going to use Season Acts because we like Season Acts so much, we even promote them. If you guys want a free month, hit the top link in the description. You'll be able to get a free month of Season Acts, which is a tool that allows you to identify some of these seasonal plays. Now, for this example, I am going to use soybeans because it is a great tool to really look into commodities where seasonal plays are the best. So I'm going to hit the popular instruments up here. We're going to have a look at commodities and we're going to go down to soybeans. Now, what Season Acts do so brilliantly is aggregate years and years of data into one chart so you can identify the seasonal patterns that happen every year. As you can see, they've got up to 34 years of data here on soybeans themselves, but for today, I'm just going to look into 25 years. And you're going to see this pattern here. As you can see visually, we're just visual learners, we can see that from the end of January here, right the way up to mid-June, soybeans seasonally gain strength in price. But then the opposite, from mid-June all the way down to the beginning of October, they drop massively. Mid-October, all the way back up to late December, we see that climb again. What this Season Acts tool allows us to do is to simply drag between dates and have a look at the data that's actually involved. For example, over the past 25 years between these dates here, we can see that it has a 60% win rate, which means 15 of those years it's profitable, 10 of those years it loses, and it even shows you that down here. What seasonal analysis allows you to do is identify years and years of patterns and data into one spot and then analyze the actual returns that can be given plus the percentage that has happened in the past. It's like backtesting a strategy, only really easy, and you can play around with this tool and you can find where best makes sense. For example, if I go from the beginning of October here up into early November, you can see that has a 68% win rate, or you can even click on their homemade patterns here and identify a couple. 3rd of October to the 28th of December, 76% win rate over 25 years. That's 19 years of success and only 6 years of losses. The average return around 5.26%. So that's about 3 months of a trade to return 5.26% on average. If we look at the average profit on those 19 gains that we had, it actually come in at 8.82 points profit. So that's actually quite an impressive 9% average profit that you can pull in through there. I'll leave you to have a look into and play around on the platform, but seasonal analysis is by far one of the biggest toolkits of my trading because you can get an understanding of whether you're in the prime time to be trading that asset or whether you shouldn't be touching it. And if you're going against the trend in seasonal analysis, you know probability is not in your favor. So you need to make sure your risk management's in check. Whereas if you find a trade setup which also formats along with that seasonal analysis, you can give yourself an incredible edge moving forward. And last but not least, I'm going to give you some more shipping information, another relative topic given the global shutdowns that happened. We're going to dive into the Baltic Dry Index. As we all know, shipping is very important in modern day economies. See, a lot of people export, a lot of people import, and the price of moving those goods to each nation really impacts whether or not they can buy or sell, or whether or not the economies can generate a profit or businesses. So it's really important to understand what these shipping prices are as a whole, because if they're skyrocketing, then you know those exporting countries or those importing businesses may struggle a little bit to cover cover those costs and their performance may be hindered. This allows you to position better when it's talking about trading public companies or currencies themselves. We're going to jump back over to TradingView for this one, and the ticker you're looking for is BDI. You simply just click up the top left and type BDI. It should be one of the top ones there, the Baltic Dry Index. It's by index. If you click on that, this is the chart you're going to be seen with. I prefer to look at this in a line chart rather than candle charts, so that's why it might look a little bit different from you. But essentially what this does is measure global shipping rates. So any sudden spikes in this index indicate rising demand for shipping, which often precedes price increases for goods and commodities. So if you see this index rising at any point, you might want to adjust your commodity trades like oils or metals, as it could signal supply chain bottlenecks and inflationary pressures. Things like the war in the Middle East have obviously had an impact as well. As fear grows, the BDI does grow, and how well they can actually move these assets. If the cost of moving the assets rises, then the cost of selling the assets also rise, and it just infiltrates the whole market as a whole, and next thing you know, inflation's through the roof again. So freight rates can also give you early insights into global demand and economic activity. This Baltic Dry Index is the most beautiful way to just get an idea. Compare it with your assets, your commodities, and you'll see the impact that it can really have. It is best to do it here on TradingView so you can really dive in. Other websites like investing.com or Trading Economics will give you the Baltic Dry Index, but trust me, if you want to be able to play around and overlay different assets and have a look at the impact, TradingView is the best spot. So there you have it. 5 advanced trading tools to help you gain a better edge in the market. Play around with them and have some fun. Apply these to your trading strategy, and don't just trade with an edge, trade with the power of macroeconomics behind you. Thank you for watching. If you did enjoy it, leave a comment, leave a like, and we'll see you next time.